Here's where we're just going to look at the U.S. and we want to kick off with some of the expectations on what is being deemed, a soft landing. So the most likely global outcome, the expectations are for a soft landing, not a hard landing. And for those that have been following us, I don't disagree in terms of hard landing versus soft landing. My problem is the expectation will be short-lived. One of the things that we've been talking about is that it's going to have more staying power in terms of this anchor, if you will, to growth and how it's going to take time to get to the other side of it. So the latest global fund manager survey shows increase in number of investors who believe soft landing is most likely outcome over the next 12 months, slight expansion in the no landing crowd. Now, it's going to be something. I don't know if you'd want to pivot and say it's a hard landing because, it'll last longer, but there's definitely a problem that is going to be there in general. Now, when you look at the leading economic index from the conference board, it fell in June by negative 0.7 month on month, which is worse than the prior month of negative 0.6. Year-on-year decline, which is, as you can see here, has slipped to negative 7.8 and continues to be consistent with declines in prior recessions. So again, there's nothing that is pointing to how we won't be in a recession. It all is pointing towards something very similar. And the issue that we have when you look at the S&P 500, because there's been this nice little rally, it's interesting because the liquidity and credit facilities, the bank term funding program, which remember was started after SVB went bankrupt, you started to see the pressure on the smaller banks, and the Fed turned around and dumped additional liquidity into the market, and it's not surprising to see that turned into a rally in the S&P 500 because any excess liquidity shows up in the S&P 500. When you look at this 45-degree angle that has hit a significant amount of tech stocks where you've had this very steady state recovery, and a lot of this is tied back to a significant amount of that liquidity that was re-injected into the market. So this, as you can see, has not come out yet. They've tried to take other liquidity out, but you still see a significant amount sitting in the market, which is why when you start looking at some of these key pieces on the inflation side and the different layers of underlying inflation, core CPI, and this is again looking at the 12-month side, is still at 4.9%. Median CPI is still at 6.2% and is actually higher than it was in June 2022, which again, more of this kind of staying power. The Cleveland 16% trimmed mean is at 4.9, in line with core, which again is keeping that staying power. Atlanta Fed sticky has actually gone up from in June 22 is 5.6. Here it's 5.8. So when you look at these pieces and these problems, where is the trajectory? None of this is showing an extensive slowdown. It's showing that the rate of change is dropping, but month on month prices are still going up. And there's nothing that's showing it won't. When you look at another piece, so the New York Fed staff UIG measure, which is this one to the right, the UIG is a full data set measure for June, is currently estimated at 3.2%, a 0.4 percentage point decrease from the current estimate of the previous month. Prices only measure for June is currently estimated 2.5%. The 12-month change in the June CPI was 3%. So you can see the trend is coming down, but when you go back to 1996, you're still at the highs. So, and again, looking at the rate of change, it's slowing, but as we've been saying, the month on month is still the killer when you look at how it impacts the underlying consumer. So, and how is it impacting them? Again, credit card delinquency rates at 2008 levels. Delinquency rates for credit card borrowers by age, as you can see, 20s, 30s, 40s. These individuals that are moving into, I don't want to say the golden age, but the prime buying, the prime consumer of that 25 to 54 is seeing an increase in delinquencies. And the problem that we see and why we think it's only going to get worse, you do have that transition of student loans coming back, which on average is anywhere between $350 to $500 additional payments per month. That's only going to move this up higher. Auto loan transitions to serious delinquencies are approaching 2008 levels. So all of the stress points, and one of the reasons why this is worse, especially on the credit card delinquency side, we're at a record for credit card rates. We're at 21, 22% on average. So that compounds quickly, because if you don't pay off your monthly bill, you get charged that amount the next month. So it's not like it's slowly ramping up. You're getting hit right away, which is impacting things much quicker when you look at that rate of change of what happened versus 07, 08. Then when you look at what is that creating, well, that is creating lending rejection rates that are increasing on auto loans and credit cards. Auto loans and credit cards where they're just saying, we're not going to issue this because you are not credit worthy. When we look at the credit rate adjustment, we've seen actually more people that are seeing their credit score fall. People that were 680 are becoming 620, and you're getting a steep drop. And a lot of that is because they're carrying bigger and bigger credit card balances. For those that follow or track their credit card, their credit history the way I do, which I'm a crazy person. It's a hard ding if you have a big credit balance that hits you fairly hard when you're looking at those inquiries. And then when you look at the U.S. financial conditions, they've actually continues to move lower. They've eased, which technically means that it's getting a bit easier. So this is where it's like, okay, well, for the consumer, it's getting harder. For corporations, it's getting a bit easier. So then the question comes down to, well, the Fed is kind of stuck. They have to keep pushing rates up, which I think there's now a 99% certainty of a 25 basis point hike in the coming cycle. Which makes sense. I mean, as we've been saying, we think that's a foregone conclusion at this point. But this is what they're looking at when they're looking at some of that pain. Credit card delinquency at small banks, because remember, small banks are actually some of the largest providers of credit cards, especially on the local side. It's at a high. It took out the highs that we saw during COVID. It's well above what we saw during the 08, 09 crisis. So credit card delinquencies at small banks is at an all-time high at 7.24% of credit cards. And then when we look at some of the readings on new orders, this is the 14th negative reading in a row for new orders. This is looking at the Philly Fed. Employment, which the Fed is trying to break, is the only thing that keeps the train on the tracks when you're looking at the Philly side. But when you look at delinquencies, when you look at credit card stress, it's no surprise to see new orders coming down. But if new orders are falling, well, how much growth can we really get going forward? And then you have rent and income growth. So rent has gone parabolic. You can see it's continued to go up. And then another high frequency reading measure of retail sales from the Johnson Red Book showing a contraction year on year. And this is showing a drop of negative 0.4%, which is the worst since September 2020. So we had okay June numbers. When you account for inflation, they weren't as good. But now, nominal side, you're fully rolling over. You're starting to see that pain really creep up, and we're going to look at this in some other time frames to see if it's gotten why it's such a problem. The Fed discount window, combined use of the Fed discount window and bank term funding has stabilized in terms of growth. But when you look at it, it's still elevated and it's not rolling. And that's where you continue to see some of these stress points. And the market expectations for a Fed fund rate this year have been priced out, which is a major change from mid-March when 5% Fed funds rate was unthinkable. And for those that have been following us, we've been saying it was going higher. People thought we were crazy. But the thing that we disagree with looking at this chart is that the rate cuts. We see this elevated number and this staying much longer in the system. The federal government receipts are now negative. It's not surprising when you have wages weakening, when you have information and things slowing. And then when you look at CFOs who say this shows share of CFOs who say it's a good time to take greater risk. It's down to 33%, which just means that people are tightening their belts. If they're tightening their belts, you're not investing, you're not generating new income, you're not generating new growth, which again is going to reduce your underlying tax bill. So that's where you see the government receipts coming down, but government receipts are coming down just as the Fed, the deficit is rising, but interest rates are going up. So it means that the interest expense we're paying is surging. And as we were saying, for those that said, interest expense is a rounding error, it's like, well, it stops becoming a rounding error pretty quickly when you see the compounding nature of it all. This is just giving you an idea of where the deficit is and why we keep talking about the problem with the deficit. And then this looks at the U.S. growth in federal receipts versus outlays. So the receipts, again, continuing to diminish as the outlays continue to remain elevated, creating that struggle. But the Fed can't worry about that. The Fed, realistically, the government needs to tighten its belt and start cutting back on some of these programs in order to start to right the ship and to bring some of this down, because the options are increased economic growth, which is going to be very difficult right now, or cut outspend. And because we've been so frivolous with our spending for so long, we have no choice, even though technically in this type of environment, you should be increasing your deficit and trying to finance things and put that support out there. But because we never tightened our belts, you don't have the ability to do that. And then because we launched such a massive support during 2020, 2021, we don't have the ability, again, under that law of diminishing returns. So then when you look at the business sector in general, the unit labor cost is rolling over a bit, but the corporate price deflator is starting to bounce back up. So profit margins are shrinking, and that's why companies have to accelerate those price hikes. And we talked about it last week, where small businesses actually talked about raising prices. So they're raising prices because they have to, and then there was another chart that we showed where they gave the reason why they're raising prices. It's to protect margin. So they haven't seen their sales really slow yet, based on what we're talking about with the consumer. That should change a bit, but they're going to do it. And the financial conditions, what they're seeing has gotten better, as we said earlier, just again, reiterating that fact. So the Fed is looking at this and saying, okay, well, you're taking prices up again. Wages are still elevated. They've started to come down, but going back to 1999, still the highest they've been, as conditions are actually easing. It's like that is nothing that they want is in this chart, these charts right here, which is why we do see that additional rate hike. Now, the funding of unicorns has plummeted. Unicorn companies, startups with market valuations of at least $1 billion, brought in nearly $132 billion in funding, when you looked previously, and then unicorns have raised just $42.1 billion this year. And it's just because unless you have cash flow, nobody is willing to come after it. And then that's, again, showing that ease in which, even though that's happening, technically it's getting easier to get money. So that could change, but that's something that we think that the Fed is going to want to address. Then when we look at the New York Fed SCE Credit Access Survey rejection rate among applicants for auto loans and credit card loans, you're getting an idea of the increase as we talked about earlier. But it's important to look at the loan application rejection probability increases for all loans. So first we were looking at auto and credit loans, as we showed earlier, just reiterating that chart. But then look at everything in general. Credit card limit increases. Those rejections are increasing exponentially. Credit cards in general, mortgages, mortgage refinancing, auto loans. So everything that the consumer could realistically go back and ask for is being cut back. Average loan rejection probability reaches new highs. The readings for auto loans are 30.7%. Mortgages 46.1%, and credit card limit increase requests 42.4% are all new series highs, which is why, again, the stress at the consumer is starting to reach an apex, which is why we've been talking so much about that slowdown in spending, which is what we talked about when we're looking at activity rates, and why we think that's going to continue to be a problem. Non-smooth version of the Atlanta Fed wage growth tracker. When you look at it since then, it has swung wildly, with latest move through June to the downside, not yet below where it fell to in April. So again, when you look at the wage growth front, it's slowing, but it's still the highest it's been going back to 2000. Things they want to address when you're looking at the Fed, when you're looking at the fear of that wage price spiral. Higher income households starting to worry about whether they can make minimum debt payments. And this is interesting because the higher income, obviously, you have more income, but typically based on the society we're in today, people tend to spend more. So they make more, but then they spend more. So there's actually seen a sizable increase, and as the debt and the cost of that debt grows, you're seeing that there. And that's why we do see a bigger slowdown in that activity, which is why they're some of the largest buyers. So the U.S. same-store sales are down 0.2% year on year for the week. Sales at stores open at least a year or same-store sales fell that 0.2% in the July 15th week compared to a year earlier. Month-to-date sales through July 15th fell to 0.3%. So again, you can see that precipitous drop-off. And one of the things that we were talking about, because you kind of bounced around, especially in March, and our call was that March was the peak after they tried to bounce it back, and now you're going to see that continuous drop, which again is why we're saying it, because here's the data giving us that confidence in that outlook, which is, again, moving further up the supply chain. June industrial production came in at negative 0.5% versus the estimate of 0. Factory production came in at negative 0.3% versus 0% estimate. And as you're seeing, again, that slowdown as it rolls over, intermediate demand metric for PPI, inflation fell 9.4% year on year in June, largest annual drop, because you're seeing, again, that slowdown in activity, the slowdown dropped in general, which is putting some of those pressure points there. So then industrial production saw the first year-on-year contraction since the beginning of 2021. And then when you look at the Philly Fed data, July Philly Fed index came in at negative 13.5 versus the estimate of negative 10. New orders weakened, remained in contraction. Prices paid softened, but yet still expanding. Shipments reversed sharply into contraction. And as you're seeing, a 6-month outlook improved sharply. So there is some of that positive side in terms of that spin. But when you look at industrial production, look at the consumer, we do think that'll be short-lived, especially when you look at new orders weakening, continuing to be contraction. And again, prices paid still elevated. Again, that showing that more of a stagnation and less of a deflation. And that's why we want to carry this forward and talk more about, what to expect from the U.S. consumer as these credit issues continue to crop up and put additional headwinds on what the consumer can actually spend.